45 is overstating his benefits from the Mexico tariffs. 45 is overstating benefits of his threatened tariffs on automobiles and parts imported from Mexico while glossing over the likely harm to American consumers of substantially higher prices for new cars. In tweets Tuesday, 45 exaggerated how much of the auto industry had moved to Mexico and inaccurately asserted that if he imposed a tax of 25% on all Mexican goods, he believes that all the automaker jobs would immediately return to the U.S., and that's not the case. It would actually take years for auto assembly plants to move back to the U.S., if at all, as companies gauge which countries are cheapest for production and whether U.S. tariff policies might be reversed after the 2020 election. The squatter also overstated the size of the U.S. annual trade deficit, with other nations leaving out services that the U.S. provides, such as banking and tourism. 45 had threatened the tariffs before suspending them upon announcing a deal with Mexico last week to curtail the flow of immigrants from Central America. He says he will reimpose the tariffs if Mexico doesn't follow through on its agreement. A look at the claims. 45 tariffs are a great negotiating tool, which they're not. A great revenue producer, and most importantly, a powerful way to get companies to come to the U.S. Not true at all. And to get companies that have left us from other lands to come back, also still not true. He says we lost 30% of our auto business to Mexico, which was in his tweet Tuesday. 45 says that they took 30% of our automobile companies. They moved to Mexico. All of the people got fired. That was an interview on Monday with CNBC. The facts, he's incorrect. 45 is incorrect that Mexico took 30% of the U.S. automobile business in the years since the North American Free Trade Agreement took effect in 1994. I'm not sure where 45 is getting the 30% from, but it says since 2017, 14% of the vehicles sold in the U.S. were imported from Mexico, according to the Center for Automotive Industry. .45 believes that if the tariffs went on at the higher level, they would all come back. That was a tweet that he sent out Tuesday. 45 says what will happen is the companies will move to the United States back where they came from. They would all move back if they had to pay a 25% tax or tariff. 45 is being overly optimistic that auto companies would immediately move back to the U.S. if there were a 25% tariff on Mexican-made vehicles and parts. It takes 3 or 4 years minimum to plan, equip, and build an auto assembly plant, so there would be little immediate impact on production or jobs. Auto and parts makers are global companies, and they would also look to countries without tariffs as a place to move their factories. The companies could also just wait until after the 2020 election, hoping that if 45 is defeated, the next president would get rid of the tariffs. They're not going to invest in a duplicative capacity in response to short-term policy incentives, said Kristen Zigzag, whatever the hell that kind of name of that fucking is, a vice president at the Center for Automotive Research. It is possible that some production could be shifted back to the United States. General Motors, for instance, makes about 39% of its full-size pickup trucks at a factory in Mexico, mainly light-duty versions. According to analysts at Morningstar, if the U.S. slapped a 25% tariff on assembled automobiles, GM could shift some production to a factory in Fort Wayne, Indiana that also makes light-duty pickups, but there are limits. The plant already is running on 3 shifts and it is almost near maximum capacity. Tariffs in Mexico more than likely would cost auto jobs in the U.S. too, because Mexico would almost certainly retaliate with tariffs of its own. Tariffs on both sides would raise prices of vehicles because automakers probably would pass the charges onto their customers. Industry experts say higher prices would cause more buyers to shift into the U.S. used vehicle market, cutting into new vehicle sales. Tariffs could be higher than 25% because parts go back and forth across the border multiple times in a highly integrated supply chain. Vehicles built in Mexico could get 20 to 30% off of their parts from the U.S., so the tariffs would drive up prices there. That would hit lower-income people hard because automakers produce many lower-priced new vehicles to take advantage of cheaper labor. About 60% of the U.S. vehicle and parts go to Canada and Mexico, according to the Center for Automotive Research. .45 claims that, he says, look, without the tariffs we would be captive to every country, and we have been for many years. That's why we have an $800 billion trading deficit for years. We lose a fortune with virtually every country. They take advantage of us in every way possible. The fact is, 45 isn't telling the whole story about trade deficit. When he refers to the $800 billion trade gap, he's only talking about the deficit in goods such as cars and aircraft. He leaves out services such as banking, tourism, and education, in which the U.S. runs substantial trade surpluses that partially offset the persistent trades in goods. The goods and services deficit peaked at $762 billion in 2006. Last year, the United States ran a record $887 billion deficit in goods and $620 billion surplus in services, which add up to an overall deficit of more than $627 billion. The U.S. does tend to run trade deficits with most other major economies, but there are exceptions like Canada, which they nearly have a $4 billion surplus, Singapore with 18 and Britain with 19. Mainstream economists reject 45's argument that the deficits arise from other countries taking advantage of the United States. They see the trade gaps as the result of an economic reality that probably won't bend to tariffs and other changes in trade policy. Americans buy more than they produce, and imports fill the gap. U.S. exports are also hurt by the American dollar status as the world's currency. The dollar is usually in high demand because it is used in so many global transactions. That means the dollar is persistently strong, raising prices of the U.S. products and putting American companies at disadvantage in foreign markets. So of course 45 is going to over-exaggerate everything.